The Big Four Banks. What do you think of when I say that? Obviously, they are the Commonwealth Bank, Westpac, NAB, and ANZ. But what is the actual difference between the four, apart from just better or worse interest rates? Are you any better off as their customer or as their shareholder? Which one makes the most money off you, and which one can you make the most money from? In this video, we are going to take a look at each of these banks and find the important differences that can make or break the bank. The four big banks in Australia are actually among the most profitable banks in the world. Together, they account for a huge 80% of the mortgage market share back in 2012. But now, in 2021, that has reduced to just 60%, with the smaller banks making a significant resurgence and the rise of neobanks also taking a share. Now, here's a really simplified way of describing how banks make money. A person depositing their savings into a bank account receives a small percentage back from the bank in return for entrusting them with it. A large part of this deposit can then be lent out by the bank as a loan to someone who wants to buy a house, for example, and the bank profits by charging them more interest than it has to pay to the person who deposited the money in the first place. Of course, this is a very simplified version of how the bank's business model works, but in reality, there are plenty of complexities that come into play here. For one, banks actually don't require deposits to make money off lending, nor do they require lending to make money off deposits. But the two functions synergize very nicely with each other to create what we would typically think of as a bank. To increase profits, the bank will need to make sure that it was attracting and retaining more deposits in order to keep expanding lending. So all of this is great, but how do banks differ from one another? If this is the proven business model, how do they differentiate themselves? Well, it's what they do with the margin that they make to create financial products that separates them. This is a huge myriad of offerings, which includes the website where you can do online banking, the design and usability of the phone apps, the payment terminal services or mortgage packages, even the number of bricks and mortar branches, which makes it accessible for the locals. And this is just the retail sector, which includes everyday people's banking like you and me. There's also the business sector where banks provide the same financial services, but to businesses looking to buy new assets, make large transactions, and track and control all business expenses for a larger service fee. Finally, the last business unit is the institutional lending, which is financing even bigger companies like large global corporations or even government entities to fund large public projects. Also, all four big banks have a New Zealand division as well, and even though it isn't technically a business division because it's a country, it does get treated as a separate business entity in terms of their operations. Now, just like how Qantas actually owns Jetstar to compete for a different market, the big banks also own smaller bank brands to win over customers who refuse to bank with the big four. For CBA, they are the owners of Bank West and a whole host of other financial companies, including Aussie Home Loans, for example. For Westpac, they own St George Bank, Bank of Melbourne, and Bank SA. NAB owns the popular online-only bank UBank, and ANZ doesn't own any other businesses at all. Now, let's compare the big four banks in 2020 and see how they stack up in terms of the business entities that we mentioned earlier. For the retail division, CBA leads the pack with $4 billion in profit, followed by Westpac with $2.77 billion. NAB comes in third with $1.4 billion, and ANZ releases its retail and business entity together as one figure, so I'm just going to estimate it at $1.3 billion. For the business group, CBA again leads the way with $2.65 billion, closely followed by NAB with $2.5 billion. So you can see that compared to its retail profits, NAB is actually more invested in funding businesses than personal banking. ANZ is estimated to have around $1 billion in business banking, and Westpac brings up the rear at only $0.7 billion, which means that Westpac is more geared towards personal banking with the help of subsidiaries like St George Bank. For institutional lending, ANZ leads the way with $1.8 billion of profit, making them more focused on governments and large corporations than the others. NAB follows closer behind at $1.5 billion, CBA comes in third at $0.65 billion, and Westpac brings up the rear at $0.6 billion. Finally, each of the banks also have a New Zealand division, for which ANZ and NAB are tied at $1 billion in profit each. CBA comes in third at $0.8 billion, and Westpac last at $0.6 billion. Now, let's sum all of this up and see how profitable each bank is compared to their size. And no surprises with CBA leading the way at $7.5 billion in net profit and truly deserving of Australia's biggest company. Westpac would have made $3.3 billion profit, but they got whacked with a $1.3 billion fine for breaching the Anti-Money Laundering Act, so they are down to $2 billion instead. NAB brought in $2.6 billion, mostly from its business division, and ANZ is really punching above its weight at $3.6 billion, even though they are the smallest of the big four thanks to its strong institutional lending and its New Zealand group as well. There are plenty of advertising and promotional offers to entice new customers to the bank, and those customers don't really care about the future of that bank. In fact, I'm sure most people secretly wish that their bank will go out of business so that their loans might be forgotten. So we're going to take a look at the future of each bank from a shareholder's perspective. For CBA, they've invested in the buy now pay later service Klarna to take on Afterpay, and also introduced a zero interest credit card as a two-pronged attack on the giant Afterpay. CBA also launched CommBank Advanced Pay at the end of 2020 to let you spend your wages before you get it, and partnered with Backer, which provides tools to help people start new businesses. All of these are aimed at millennials, which will really cement CBA's position as the leading bank, and investors can look forward to stronger earnings growth over time. Westpac, on the other hand, has struggled in its mortgage share, which has been falling even before the pandemic happened. Coupled with the AUSTRAC penalty and a further $1.7 billion investment to fix compliance and risk, 2020 will be a year they would like to forget. There has been some good partnerships made by Westpac though to stay relevant, including one with SocietyOne and another one with Afterpay. But this is only a small step to get its earnings back on track again, which was definitely helped by its investment into Coinbase, netting it more than $500 million. NAB has had a better run with the acquisition of the neobank 86,400 to help accelerate the growth of its Ubank brand. NAB was also the first to launch a zero-interest credit card as its way of combating the rise of the buy now pay later trend. Its strategic partnership with Microsoft to migrate applications to the cloud will also help to streamline the business and reduce future expenses, which will boost earnings and keep the dividends for the shareholders flowing as well. Finally, ANZ has pretty much refused to enter the buy now pay later space, believing that it's not a sustainable industry, and instead decided to focus on its own customer loyalty and reward programs, such as its investment into the ASX listed Cash Rewards. It has also partnered with the European payments company Worldline to help improve its lead in the business and institutional markets, and so is looking to improve more traditional banking divisions rather than chase new ones, a move that is definitely a lot safer than trying to innovate a new industry. So, from all of this so far, the banks are indeed very much similar in their business model, but also very different in their strengths. And they have very different visions for the future as well. As a bank customer, you probably won't notice that big of a change between banks, but to a shareholder, the earnings, the strength of each division, and the future direction matters greatly because it affects the share price of each bank, as well as the stability of the dividends that gets paid out. In fact, if you can afford to, I strongly suggest to transition away from being a bank customer and into a bank shareholder. You'll get a return of around 5% in dividends alone compared to just 1 or 2% in savings rate nowadays. Pick a bank that you believe in with a focus in the right direction. If you think the buy now pay later space will take off, CBA is a good bet. If you're anticipating a strong business recovery, NAB is in a good position. If you want a bank that'll bankroll institutions, ANZ is the right pick. And if you're after a value stock in banking, Westpac is slightly undervalued right now. With the right attitude and some knowledge of the banking sector, a shareholder will almost always come out on top over a savings account with any of the big 4 banks. Thanks for watching the third of my series comparing similar banks on the ASX. If you want to see a specific comparison between groups of companies, let me know in the comments down below. Don't forget to hit the like button for this video if you liked it, and make sure to subscribe to the channel to get notified when I drop the next video. Thanks for watching guys, and as always, I'll see you in the next video.